Okay, good morning, everyone. It's 11:02 a.m. We will start today's webinar. Topic is the biggest captive insurance objections we hear and how to have a realistic perspective about them. I'm Chris Gallo, your host, the managing director here at CIC Services, and I will be interviewing Sean King, the principal and in-house counsel for CIC Services. Before we get started, a little housekeeping. Please keep your computer on mute unless you are asking a question. Thank you. A real little bit about myself. I just concluded a 35-year regulatory career with the Connecticut Insurance Department, and I tell people the one major lesson I learned was the critical importance of sustainable liquidity and cash flow in any enterprise. And with that, I'm going to let Sean King introduce himself. Go ahead, Sean.
Hey, everybody. I've just looked through the participant list and see some familiar names and some I don't know. But I'm Sean. I'm attorney and CPA, one of the founders and in-house counsel for CIC Services. And I'm very much looking forward to our conversation for the next rest of the hour.
All right. Thank you. A little bit about CIC Services. We've been helping business owners manage the risk through captive ownership since 2005, and with the innovative use of captive insurance companies. I say innovative because I do feel as if that we are a very innovative company. About CIC Services, I mentioned earlier about the critical importance of cash flow and liquidity. But CIC Services, we help businesses own their own insurance company, which helps them establish asset-protected loss reserves, increase profit, wealth, generally by millions of dollars. They are able to lower and control their insurance costs, insure previously uninsured or underinsured risks like COVID-19, and benefit from insurance company tax treatment. You might have heard about CIC Services. We made national news. We sued the IRS, which went all the way to the Supreme Court in May of 21. They ruled 9-0 in our favor, which was a major victory for our clients. And then after that victory, it was remanded back down to the district court for settlement, and basically they ruled 100% in our favor as well, where they ordered an injunction against the IRS's unlawful notice of 2016-66.
Yeah, just real quick, Chris.
Go ahead.
There's a big tax court case that just came out yesterday regarding a different IRS notice, 2017-10, I believe it was, dealing with conservation easements. And based upon that Supreme Court precedent, our victory, the tax court voted overwhelmingly in favor of the taxpayer, striking down notice 2017-10 also. So this is the third, I believe, notice to be struck down after our Supreme Court victory, and I believe there will be likely many more.
Okay, once again, we were the trailblazers and opening up for other industries to challenge the IRS's wrongful approach in many cases. A little bit more about CIC Services, and basically, largely in part because of how we fight for our clients, we also won the Middle Market Captive Manager of the Year in 2021. Oops, hold on one second. And what do captive insurance companies do? We replace commercial insurance. We insure enterprise risks, which are risks that are formally like self-insured. We insure warranties, issue performance bonds, insure employee benefits and health care, and any combination of the above. So getting back to our topic now, the biggest captive insurance objections we hear and how to have a realistic approach about them. Number one, the IRS hates captives. So Sean, can you give us a perspective on, does the IRS hate captive insurance companies?
The answer to the short answer is yes, they absolutely do. That's the bad news, I guess. The good news is that with a few exceptions that I'll come back to in just a second, their attacks on captives have been very much largely unsuccessful. They began attacking captives pretty viciously in the 1970s. They pursued, 8 or 10 different big court cases against the larger varieties of captives, the type that Fortune 1000 companies typically use. And they effectively lost every one of those tax cases of consequence. They lost the Humana case, the UPS case, the Rent-A-Center case, the Securitas case, the RVI case. They just got destroyed in the courts. And since then, they have turned their attention, starting, depends on how you measure it, but starting back in the mid to 2008 timeframe or so, to the smaller variety of captives, the so-called 831B electing variety. So there are two types of captives from a tax perspective. There are those that are taxed just like any other insurance company would be, subject to normal insurance company rules. We call those sometimes 831A captive insurance companies. And those are actually pretty favorable rules. Insurance companies are able to deduct things that ordinary businesses are not. Ordinary businesses generally cannot deduct this year expenses that they expect to pay in future years. Not so with insurance companies. Insurance companies can actuarially predict what their future claims are going to be. They can set aside reserves today to back those claims and get a tax deduction for expenses that they may not pay for 1, 3, 5, 10 years. Now, the 831B electing variety of captive is typically for smaller captive insurance companies, those taking in 2.4 million per year or less of premium income on an annual basis. And they can elect, it's not automatic, but they can elect to be taxed under Code Section 831B. And if they do so, they pay tax, and they're a legitimate insurance company, they pay tax at a 0% rate on their underwriting profits. So if you have a legit insurance arrangement, you pay $1 million of premiums to your captive to ensure actuarially determined risks. Your business gets $1 million tax deduction, just as if it had bought that insurance from State Farm or Lloyd's of London, somebody else. And if the captive has made the 831B election, the captive takes in that $1 million of premium effectively in a 0% bracket. So $1 million deduction on one hand, no taxable income to your related entity on the other hand. You can see there's some pretty extraordinary tax savings opportunities, which is why the IRS has a great deal of disdain for these captives. The IRS has aggressively attacked 831Bs in the recent years. That's the bad news. They've won, I guess, 4 or 5 tax court victories now in a row involving, I think, challenging fact patterns from the taxpayer's perspective. Certainly fact patterns that look nothing like the captives that we manage. But they also know that their day is coming. There are several hundred cases currently pending in U.S. tax court. They will be ruled on over the next couple of years, and or many of them will be, and many of those, the clients or taxpayers are ultimately going to win. And that's going to really box in and limit what the IRS is able to do. So in the meantime, they're running a pretty aggressive extortion campaign. They are trying to force people to settle these arrangements before the tax court has an opportunity to really define the law and make it clear that in many cases, these captives that the taxpayers or the IRS is criticizing are perfectly legit. So that's a nutshell on sort of the IRS's view of captives. I do want to talk about some ways of potentially mitigating this risk, right? So we're going to talk about 2 or 3 ways here. One way on this slide is to decide whether or not or when you make the 831B election, right? One of the reasons that clients are saying we're not going to do a captive this year is because, and not many of them are, we're gonna have our best year ever, but of those who are, IRS fear is the biggest reason. Well, what if you could form your captive this year? What if you could get all of the insurance benefits that you desperately need? If COVID and some of these other things haven't really driven home the significance of those insurance benefits, I don't know what could. But what if you could form your captive this year, pay premiums this year, and really get most all of the tax benefits, assuming it's a legitimate insurance company, and not have to worry about making the 831B election for almost 2 years? What if you could do that? What if you could set up a captive today, get the insurance benefits, get most all of the tax benefits, and not have to decide until the fall of 2024, October 15, 2024, whether or not your captive is going to make the 831B election? Well, you can actually do that. I'm not going to get into details of that today. Happy to have conversations with you or your CPA about that. But that's relatively easily done. And what it does is it allows you to go ahead, move forward, and buy time. Within 2 years, we'll almost certainly have better guidance from the tax court. We'll almost certainly have better guidance from the Congress and or the IRS. And then you can use that better guidance to inform the decision then of whether or not to do the captive insurance company. So don't let this IRS scrutiny of 831Bs scare you. The good news is they've largely backed away after that series of court losses I mentioned earlier from scrutinizing the non-831B variety of captives. So you can go ahead and form one. Don't make the 831B election this year. Wait really until October of 2024 to decide whether you want to make the election for the 2023 year, and still get much of the potential income tax benefits that you're otherwise eligible for, even if you had made the 831B election. So just know that's a possibility on the table. Next slide, Chris.
Yeah, that's a good strategy, Sean. Thank you. So next slide. Number 2, I don't have the cash to pay setup, capital, and premiums.
Yeah, we hear this a lot, right? Clients, they understand the need. They may have even suffered major COVID losses or other losses over the last 5 or 10 years. And they understand the need for these more strategic types of insurance, supply chain interruption, reputational damage, all of these sort of things. And in some cases, the one thing that's holding them back is just cash flow. They don't have the free cash flow to pay $500,000 in insurance premiums this year. Maybe they're working on another project or whatever. And so they delay, thinking that, once this project's behind us, we'll do the captive next year. And they often do it next year. But what if you could go ahead and do it this year? Well, there is often a way to help bridge the gap, and that's called premium financing. There are lenders out there, including ordinary commercial banks, who are perfectly willing to make essentially non-recourse loans to your business that it can use to pay premiums on the captive insurance policies, accepting those captive insurance policies as collateral for the loan. So that if you ultimately default on the money that's loaned to you, they simply surrender those policies that were pledged as collateral, the policies issued by the captive, and they collect the unearned portion of those premiums and apply that toward the loan that you owe to them. So it's a very effective, very cheap. The interest rates on these loans are really low because the lender is very well secured. So a very cheap and often effective solution for coming up with the money to pay the premiums and get the desperately needed insurance coverage in place. Another potential strategy, and this, I'm just blown away at why this isn't more obvious, but I fell for this myself for many years. The other potential strategy is to spend your savings, particularly in this example, on captive premiums, and save your income, right? A lot of people say, well, I don't have cash in my checking account, in my business checking account to pay the premiums to my captive. but they may have lots of savings inside the business in other ways. They may have a stock or bond portfolio that they've already paid taxes on, right? Well, what if you sold that stock or bond portfolio? Especially at the moment, you might even generate a taxable loss by doing so because markets are down pretty steeply at the moment. What if you sold that stock or bond portfolio? You spent that savings on captive premiums and then replenished that savings through future income that your business earns. It's just a very simple thing. It's a much more tax efficient way of potentially paying these captive premiums because you're using an asset, in this case, savings or an investment portfolio that has already been taxed and that might even generate some losses that you could harvest if you were to cash it in today.
Okay, those are two good strategies. Thank you. And then the third question, I don't want to insure the risks of other businesses.
We hear this a lot, and there's a multi-pronged answer to it. Everybody fears, what they don't know, right? And they understand their own business, they understand their own industry. And so there's a natural temptation among inexperienced or people who are inexperienced in the insurance business to think that their risk is better managed if they limit it to what they know, if they only insure their related business, or if they only insure businesses in their industry. But if you look at actual insurance companies, nobody does it that way, right? I mean, there are very few, almost no insurance companies that only insure the automobile manufacturing industry, or only insure the coal mining industry, or only insure whatever industry you or your clients may be in. Rather, they realize that actuarially speaking, our risk is lessened when we have different businesses from different industries with different risk profiles pooling their risks. That actually lowers our overall risk of loss. Whereas if we have, we're insuring only our business or only our industry, we have a situation where a particular bad event might adversely affect a single industry much more than other industries. And we could end up having massive losses because our entire insurance structure is based on the losses of a single industry. So distribution of risk, spreading that risk among multiple parties actually reduces the overall risk exposure. It reduces the volatility of the losses our captive is expected to pay. It's insurance 101, but it's amazing how often that is overlooked. Now, whether or not you actually need to insure other businesses depends on, number one, whether you care that your company qualifies as an insurance company for tax purposes or not. You may not care about that. You may not care about any potential tax benefits. So that's sort of the main consideration. If we're not really too concerned about whether or not we qualify as an insurance company under federal income tax law, you can just insure your main operating business. But if we do want it to be considered a legit insurance company under federal income tax law, we have two revenue rulings that sort of guide us about what is sufficient risk distribution. Well, we can do all related party risk distribution under Revenue Ruling 2002-90. It's a little more complicated than what you see on the screen, but the gist of it is if you have 12 or more related entities, maybe you own your clients own a business and they have different parts of the business segregated off in different corporations. If you have 12 or more entities, all purchasing insurance from the same captive, with each insured paying at least 5% of the total premiums to the captive and no insured accounting for more than 15% of the total premiums. And interestingly, if it's not a disregarded entity that we're talking about here, those 12 entities, then according to the IRS, we can satisfy risk distribution under the 2002-90 safe harbor. And in that case, we can insure only our related businesses. We don't have to insure others. Most businesses aren't able to qualify under that, small to mid-sized businesses at least, or even if they could, aren't interested in doing so. Instead, they seek to qualify potentially under Revenue Ruling 2002-89 and or various court case precedents that establish what constitutes sufficient risk shifting, risk distribution. But what 2002-89 basically says is that if your captive receives at least or more than 50% of its premiums in exchange for insuring the risk of unrelated parties, for instance, through a risk distribution pool structure, and meets a few other criteria, then it's deemed to meet risk distribution, which is one of the requirements for qualifying as a legitimate insurance company under federal income tax law. So the point here, you may not necessarily need to insure other businesses if you don't care about the income tax benefits, or if you do care, if you can qualify under 2002-90. But even if you do need to insure other businesses, you can greatly mitigate that risk by participating in a risk distribution pool that insures businesses all across the country in different geographic areas with different business models and different industries. And we'll talk next about how risk distribution pools typically work. So here's an example structure. In the bottom left-hand corner, we have our operating business that is looking to buy insurance from a usually, in this case, related captive insurance company. This is what we call a brother-sister sort of structure because the captive isn't a subsidiary of the operating business in the bottom left, but rather is owned by the same person or persons, the shareholders above, that own that operating business. So we have common ownership between the operating business on the left, the captive insurance company in the middle. And in this instance, the business pays premiums. Let's assume it's $1 million of premium over to the captive insurance company. In exchange for those premiums, the captive insurance company issues policies and agrees to cover certain insured losses under those policies, losses of the operating business. Now, if that's as far as we went, we would not have risk distribution. We would not almost certainly qualify as a insurance company under federal income tax law because our captive has not distributed its risk among multiple insureds or multiple risk exposures. So what typically happens, if that is an important consideration, is the captive will reinsure 51%, if you want to follow the safe harbor, or try to follow the safe harbor, 51% or more of its risks to a risk distribution pool. A risk distribution pool is a collection of unrelated captive insurance companies that are willing to assume some of the risks that your captive has taken on in exchange for your captive likewise assuming some of the risks that they have taken on. So in this example, you might pay $1 million of premium to your captive. The captive might cede $510,000 of that, 51%, to the risk distribution pool. And the risk distribution pool will then retro-cede back to the captive virtually all of that $510,000, less any claims that your share, your captive's portions of any claims that the risk distribution pool has related to unrelated third parties who might file claims. So that can be a little alarming, right? Let's go to the next slide, Chris. What do you mean unrelated third parties filing claims? How do I know that some unrelated third party isn't just going to come in and file massive claims and bankrupt my captive? Well, that is the essence of the insurance business, right? That's why risk distribution is so important, why you want to include a diversified portfolio of different risks from different businesses and different industries to help manage that. But there are also other ways to manage it. And in particular, let's think about a worst case scenario, right? During COVID, we had our largest claims year ever, probably no surprise, lots of business interruption claims and the like. And let's, the largest claim I think we've had was like maybe a $3 million claim under a policy up to a policy limit. But let's assume that, let's just use $1 million as a round number. And let's assume that just something catastrophic happened, right? That all of these businesses that are included in this risk distribution pool from all of these different industries, unrelated to ours and some related to ours, all had large claims, $1 million claims, which are very rare, by the way, $1 million claims all in the same year. And let's assume there are 100 captives in the pool. This slide says 120, but I'm going to assume 100 to make my math easy, right? Well, that's $100 million in claims, right? If each of those 100 captives had a $1 million claim, that's $100 million. And your captive is on the hook for its portion of that, right? Well, what is its portion? Well, in most of these risk distribution pools, they work on what's called a quota share arrangement. So your captive would bear a portion of the overall risk of the pool in proportion to the total premiums that your captive received versus the total premiums that all the other captives received, right? Let's assume that all these captives received the same amount of premiums to make the math easy. So they all received the same amount of premiums. We have $100 million in claims. Well, $49 million of those claims are going to be borne by the captive that wrote the coverage directly, right? Only 51% of the risk was reinsured to the risk pool. So we're really not dealing with 100 million in claims that the pool has to worry about. We're dealing with 51 million of claims. That's the pool's responsibility, right? Well, what if we had 51 million of claims and we had 100 captives in the pool, each of which received the same amount of premium? What's our maximum exposure? 1/100th of 51 million, right? What's that come to? 510,000, I think.
510,000.
So 510,000 is our maximum exposure in that catastrophic scenario that is almost actuarially impossible. It's exceedingly unlikely that every insured in your pool is going to hit max claim on a policy all in the same year. Never seen anything like it. But assuming it did happen, your max exposure is $510,000 for your captive. Now that's not great. You don't love that, right? But consider how much money you may have saved if you were paying $1 million in premiums to your captive. Assuming your captive's a legitimate insurance company, that $1 million of premium probably saved you $450,000 in taxes this year alone, state and federal taxes in a combined 45% tax bracket. So, essentially of that 510,000 that your captive is responsible for in this catastrophic, almost actuarially impossible scenario, Uncle Sam's really paying about 450,000 of it, right? You're using tax savings that you would have paid in taxes to Uncle Sam to bear that portion of the loss. That means that the money that's actually coming out of your pocket is maybe $100,000 or $150,000 or so. Still not great. We would rather not have suffered that loss, but hey, that's how insurance works. That's why it's here. And when your insured business suffers a loss someday, 51% of those claims in this example are going to be paid by all of those unrelated captives. And so I can tell you, there were a lot of businesses who suffered major COVID losses who were really thrilled that 51% of those losses were borne by the risk distribution pool. In many cases, it's what kept them in business.
Sean, I was just going to say, what Sean just mentioned was an extreme adverse scenario as an example, but COVID, from a regulatory standpoint, COVID really was a 1 in 100 year event. So that wasn't an actual adverse scenario in 2019. And I just recently totaled up what the captive owner's percentage of losses per year from the pool, from the reinsurance pool since inception to today. And the historical average of loss for the captive owner is only 6.34%. So it's been a very well-run reinsurance pool. An example that Sean gave was an extreme scenario. But we actually had that extreme scenario with COVID. So even with that COVID in 2019, our overall loss rate is 6.34%.
Yeah, the 2019 loss rate was obviously significantly higher than that, but
Right.
it was significantly lower than that in many other years. So it averages out over time, which again is one of the neat things that insurance does.
So is risk distribution really that risky? And do the risks outweigh the benefits?
Exactly. I mean, once we walk clients through the whole idea of insuring unrelated parties is always typically our biggest concern. But once we really walk clients through how the risk distribution pool works, once they really understand that they're largely playing with house money, if their captive is a legitimate insurance company and they're claiming the tax benefits, they're largely playing with house money. They're playing with money that they would have paid the taxes to Uncle Sam anyway. And it would take an extraordinarily large series of losses sustained over a period of several years for your captive share of those unrelated third-party losses to exceed the house money, to exceed the tax benefits that you're getting if indeed you are operating a legitimate insurance company. So at the end of the day, the risks aren't that great. And that's exactly why Congress passed this code section, 831B. It wants to incentivize small businesses to deal with these risks that are, for small businesses, real existential threats. And it wants to make it possible and economically viable to do so, in part by providing a tax subsidy for the arrangement. That's exactly what 831B does.
So last question.
There is still some time. If you're starting from ground zero, the clock is almost expired, meaning that if you haven't even thought about a captive at this point, we've got another week or two to have some serious conversations and get the ball rolling. But if you've explored a captive in the past, if you looked at a captive arrangement, if you had conversations with us or other captive managers earlier in the year and decided not to proceed or to delay proceeding over fears that of the things we've talked about today, IRS scrutiny or having to insure third parties or not having the cash flow to pay the premiums. Hopefully we've given you some ideas today that can put those concerns a little bit at ease, that will embolden you to move forward and form the captive. There's still plenty of time to get that done for this year, to get policies issued before the end of this year that would cover your business for virtually all of 2023. Against a wide variety of potentially very important risks. But the clock is ticking. And if this is something that you want to look at for 2022, we need to be having those conversations now.
Sean, I have one question from Joseph Reyes. He says, I must have missed it. What about taking the expense on the 2022 tax return, 2022 tax return? I'm thinking it's the expense, maybe the premium.
Yeah, so typically the way this works is there are variations, but often the business will pay an annual premium. And let's say it pays the annual premium in December of 2022, right? And let's just say it's $1 million premium, to pick a round number. It could be 500,000, it could be 300,000, but let's say it's $1 million premium the business pays in December of 2022 to buy insurance coverages that will insure it from December 2022 through December 2023, maybe December 20th, 2022 through December 2023, whatever. Well, when the business writes that check from the business over to the captive, does it get a tax deduction for that? Well, the answer is, if it's a legitimate insurance arrangement, yes, it does. Now, whether or not it's a legitimate insurance arrangement depends on a lot of factors, and you may even want to get a legal opinion about that. But if it is, it does get a tax deduction, interestingly, for the full $1 million of premium. Normally, you're not allowed to prepay expenses, right? If I pay in December of this year rent for June of 2023, I don't get to deduct that this year. I can only deduct this year prepaid expenses for what is it, the first 90 days or something like that of the next year. So how am I deducting $1 million annual insurance premium in December 2022 if the coverage extends through parts of December 2023? And the answer is there is an exception in the Internal Revenue Code for insurance in particular. And basically it says that you can deduct the annual insurance premium, at least under some circumstances. And it's not subject to that normal limitation of only being able to deduct prepaid expenses to the extent they come due in the first 60 or 90 days of next year, or whatever it is.
And
So
Joseph, go ahead.
I hope that answered the question. I'm not sure exactly what.
He had a little follow-up. He says he's asking in the context of deferring the decision until 2024 for a captive may be formed in 2023.
So yeah, this is we do have some time, so I can take a little deeper dive. I alluded to this, but I didn't go into specifics. Let's talk about how that would work. Let's say we formed a captive in December of 2022. We pay $1 million premium, right? We deduct it if it's a legitimate insurance company. We deduct that premium on the insured's books. The question is, how much of that premium does the captive have to take in as taxable income for 2022? Right? We paid the full $1 million in December of 2022. The captive receives the full $1 million in December of 2022. How much does the captive have to include of that $1 million in its taxable income? Well, if it makes the 831B election, we know the answer to that, right? The answer is 0, assuming it's a legitimate insurance company. But what if it doesn't make the 831B election? Well, then the answer is, the general rule is, the captive only has to include the earned portion of the premium it received. The earned portion, right? So if we paid the premium on, say, December 1st of 2022, and our tax year ends December 31st of 2022, only that 1 month, only the premium attributable to that 1 month, basically 1/12 of the total premium, is actually deemed earned in 2022. And only that portion of the premium, as I understand it, confirm this with your tax advisors, has to be reported by the captive as income. So if I paid $1 million to the captive, only maybe what, 1/12 of that, 100 and some thousand, has to be reported, and I would pay tax on that. Well, I'd actually get to set aside some reserves against it, and I might have some other operating expenses against it. But once I did that, I would only pay tax at a 21% corporate bracket on maybe $100,000 or so, or less than that potentially. So $1 million of tax deduction from the operating business for 2022, and only owing taxes on maybe 10 or 12% of that for 2022 on the captive side, and then at a lower tax bracket, corporate tax bracket, may not be such a bad deal, right? Now that takes us into 2023. In 2023, the rest of that $1 million of premium that wasn't reported for 2022 because it wasn't earned is now going to get reported for 2023 because it was earned during 2023, right? But we don't have to file the 2023 tax return until October 15th, if we extend, of 2024. And we can decide then in October of 2024 whether or not we make the 831B election for the 2023 tax year. If we do, then none of that premium that was earned none of the premiums paid in December 2022 that were earned in 2023 are going to be taxable to the captive that year. If we don't make the 831B election for that year, maybe we've gotten some unfavorable court cases, or maybe the IRS is still on the warpath and we just don't want to take that risk or whatever, then yes, we are going to have to report a significant portion of that earned premium in 2023, less claims, less operating expenses, less reserves. in a relatively low tax bracket. But we have effectively, even in that worst case scenario, deferred the tax on the bulk of that $1 million that we paid in 2022 until 2023. And we managed to pay tax even then, potentially in a lower corporate bracket than the insured's tax bracket was. So it's not a bad deal, even in that instance, especially when you keep in mind the primary benefit of the whole arrangement, which is getting this essential insurance coverage that most businesses lack. Does that help explain it? I hope.
It does. Jose has now sent me back a follow-up question, so I think it did address his concern. We have, if anyone wants a copy of the slide, just simply send myself or Sean an email, and we'll get you the slides as quickly as possible. We thank you for attending today's webinar. Wait a minute, there might be one more question. Hold on, just came up. Yes, Joe.
Yeah, happy to take questions.
Yeah, he said that addressed his concern. Thank you. So I thank everyone very much and enjoy the rest of your day.
Yeah, and just one final thing, confirm everything I've said with your tax advisors. We're happy to have conversations with those tax advisors too, to share our understanding, but we don't practice law for you or your clients. We're here as a resource and can share with you our understanding, but do run everything by appropriate outside parties before acting on anything that you heard today.
All right, great. Thank you, everyone.
Thank you. Bye-bye.